Welcome back to Home Buying Tips with Gizmo, the show where the host pees outside. It's all good, but if I do it, for some reason, it's a big deal. What issue I hear from folks transitioning from renter to buyer is, what do I do if my mortgage payment goes up and I can't afford it? My question always, what do you do if your rent payment goes up? And I hear this from a lot of people, right? Because I've worked 7 years as a lender, an underwriter, and a realtor. So let's talk about your mortgage payment to begin with. We're going to talk about why it goes up. We're going to talk about some things you can do to prevent that. We're going to talk about some issues if you do get in that position where you just can't afford your mortgage payment. Like, what are some solutions you can lend on? So first, let's talk about what your mortgage payment actually is. It is your principal, interest, taxes, insurance, and sometimes HOA dues if you're in a HOA. So let's talk about the parts of that payment that can go up from least likely to most likely. So your principal and interest payment is least likely to go up because if you have a fixed mortgage payment, it won't go up because it is fixed. However, if you have like an adjustable rate mortgage, your mortgage payment will go up when the rate adjusts. Now, you hear the word adjustable rate mortgage, you think, well, it can adjust up or down. Yeah, it can, but more likely than not, it's going to go up because when rates are high, the lenders kind of adjust the adjustment period to be not that big of a deal. So like right now, rates are in like the 7s or 6s. So you may think, okay, when rates are so high, when my mortgage or my ARM adjustable rate mortgage adjusts in either 5, 7, or 10 years, rates are going to be lower, so it will adjust down. It may adjust down, but it's not going to be like from 7 to 4 or 5, something like that, because that's not profitable to the lender. So they would not allow a setup like that. But however, when rates are low or kind of middle of the pack, like 4 and 5 are middle of the pack rates, the adjustment period is kind of set up to that most likely it will go up at the end. So if you got an ARM, your rate may adjust. It'll probably go up. If you have a fixed rate, it will not go up. So next, let's talk about taxes. So I say taxes are the second least likely to go up because in some places taxes are just fixed. It's like, okay, you have a fixed like you buy your home in 2024 and taxes just don't move in that area for whatever reason. And so if you're in a place like that, your taxes, of course, will not adjust. But more likely than not, like taxes are going to go up because what happens is your taxes are based on a percentage of the value of the property. So when the value of your property increases, which is what you want to happen, your taxes go up. So like, just to make the math super easy, let's say you're taxed at a 1% rate, which is super low. And let's say your home is worth $100. So your tax bill will be $1. If your home doubles in value, you're like, hey, that's dope, and goes to $2. Now your tax bill the next year is $2. So when the value of your property goes up, the taxes go up as well. And so I'll give you my personal example. Like I bought a new construction home, which would be very important in the story, but my taxes have gone up, or my mortgage payment has gone up from basically first year it went up like $800, then it went down $400. It's gone up and down. Some years actually gone down a couple years. And so right now it is about $300 more than when I bought the property 7 years ago. And so you might hear that $800 jump and think, yikes, what happened there? So I bought a new construction home. And so when you buy a new construction home, you need to be aware of how the taxes the first year are being assessed. There's something called improved taxes and unimproved taxes. Unimproved taxes are basically the value of the, so here's how taxes are assessed. Taxes are based on the value of the land, your property 1 year ago. So when you buy a new construction home, a year before you bought it, that land was just a dirt lot. And sorry if I didn't say it, but it's January 1st from the first one the year before you bought it. And so I'm a realtor in Dallas and would love to help you reach your goals of home ownership. So click the link in the description and just schedule a call no matter where you are on your journey. Not in Dallas, no worries, I can help connect you with a vetted realtor in your local jurisdiction as well. And feel free to share with friends, family, and foes. Everyone gets love. When you're charged the unimproved taxes, the first year your taxes are super cheap, and so are your closing costs as well. You may think this is a great thing, but here's how your taxes and insurance works. As I mentioned, your taxes are based on the value of your land the year before. So what your lender does is they have to, and then you get a tax bill like at the end of the year. So all your lender is doing is estimating what they think your taxes will be at the beginning of the year and then they pay the tax bill at the end of the year when they actually get it, like in October or November. And so once again, it's just an estimate. So if they use this unimproved estimate, which is super low, when the tax bill comes, it's going to be the real deal, and it's going to be a lot higher. And so you basically, how the escrow account works is you pay 1/12 of the estimated taxes every single month, and insurance every single month. It goes into like a kitty, and the lender uses that to pay. And so if there's not enough money in that kitty, the lender still pays the bill, right? Because the lender is not going to have you foreclose on the property. Look at this. You see this bird back there flying? That's cool, right? And so the lender's not going to let you like foreclose on the property due to taxes. So they pay the whole bill. But what happens? You have a big shortage. So you have maybe $1,200 in your escrow account, but your tax bill was $4,800. So now you're in the hole $3,600 when it comes to your tax bill. So now the lender's like, hey, you can either pay us that $3,600 shortage up front. You got about 2 to 3 months, or we can just tack it on to your mortgage payment, and you pay that over the course of the next year or 2 years if it's a huge number. So once again, let's go back to the number $3,600 deficit. That's an extra like $300 that would be tacked on to your current principal and interest payment, which has already gone up most likely because of taxes anyways, and insurance, which we'll talk about in a second, and maybe HOA dues. And then they had that $300 on top. So that's what happened to me, where my payment went up like $800 because I had those unimproved taxes. But hey, the first year I didn't have to pay a lot of closing. So it's kind of like laugh now, cry later, or whatever that saying is. So always pay the real deal tax, even though it may hurt you a little bit more upfront. You're going to be happy about it in the end. So next, let's talk about insurance. Here's the thing: your insurance is always going to go up. No matter what's going on, just think about basic inflation. It costs more to build a home one year than it does the next year because material costs go up. The insurance companies, they're just like a racket, right? Their whole thing is like, we're going to collect insurance if it's favorable to us. We're going to try everything we can in our ability not to pay out. But if there's an area where we have to pay out a lot of claims, what we're going to do next year is just jack everyone's insurance premium through the roof, or just not offer insurance in that area as well. So you may see in a place like California, Florida on the coast, a lot of these big insurance companies are just pulled out completely and aren't offering insurance. So long story short is your mortgage payment is going to go up. That just kind of is what it, or your insurance payment is going to go up. That just kind of is what it is. And then let's talk about HOA dues real quick. HOA dues, they're either going to stay, they're not going to go up or down that drastically. They may stay the same for a bit, or they may go up for a little bit. I mean, my HOA dues in 7 years has not really gone up or down that much. I think maybe like 5% or something like that. And so that's why your mortgage payment most likely will go up every single year. So let's talk about making sure you're in a position where you're not kind of jammed up when those payments go up. So first and foremost, you want to make sure that you're buying a home that you can afford, not just in a price bracket that you like the amenities around there. So here's a quick way on how to determine that. Like if you're paying your rent, let's say you're paying $2,000 a month right now for rent, you want to actually formulate a budget. And so let's look at the end of the month. Do you have money left over? Are you breaking even, or are you in the hole and just paying bills with credit cards? If you're paying bills with credit cards, you probably can't afford that $2,000 a month rent payment. So your mortgage payment needs to be less than $2,000 a month, because as we talk about, it goes up. And so you want to set your budget and figure out like, okay, what will be the optimal number that I can afford? Now you may find out, hey, I can't afford a home in the area I want to. Well, maybe you should rent another year until you can improve your financial situation. What you don't want to do is just say, hey, I deserve this lifestyle, and then you end up with a home you can't afford, then you're jammed up, and then you're going to the end of this video to talk about solutions when you can actually afford your mortgage payment. But if you're breaking even, probably that $2,000 is still a little bit too much, because you want to make sure you have money to pay your mortgage and to pay other bills after your mortgage as well. And if you have money left over, it's like, okay, hey, I can afford this $2,000 a month mortgage, or maybe a little bit more, and you want to kind of go about your home search that way. But I have another video breaking down further details on how to actually figure this out. It's real quick. You go to like Google, you go to a mortgage calculator, you can figure out your taxes by looking at the value of properties on like Zillow and things of that nature. But yeah, I'll put the longer video in the description. Now, so let's say you did everything right, but something happened. There were unforeseen circumstances. You got laid off. You had to get another job where you could not afford the payment. Something happened that was outside your control, or honestly within your control, but you just ignored the first half of this video. What do you do in that scenario? So, first and foremost, if you are in a position where you're jammed up and you know you can't afford your mortgage payment, you need to communicate that to your lender, because if you start falling behind, all the solutions I'm about to offer you are null and void, because the lender doesn't know what's going on. I mean, they'll reach out to you, but if you're ignoring calls, that's not a good scenario. So let's talk about if you're having issues, like what can you do? So you call the lender. Your lender most likely will offer you a couple solutions. One is a forbearance. So forbearance is basically putting your mortgage payments on hold. So let's say your mortgage payment is $1,000 a month. You're in a financial situation where you can't make the payment. The lender may say, hey, forbearance can go up to 12 months. We'll say, hey, we'll delay 6 months of mortgage payments until you can get back on your feet. And then after month 6, those mortgage payments pick back up. So what happens at month 6? Some lenders will be like, hey, okay, that $6,000 we put to aside for the $1,000 over 6 months, now it's due. It's weird that lenders do that, because you're kind of screwed, because it's like, hey, if I couldn't pay $1,000 a month 6 months ago, why can't I pay a $6,000 lump sum? So the lenders that do that, your solution is to potentially like refinance that loan. But yeah, that's kind of like a bad scenario. Some lenders will just put it as a lump sum on the end of the mortgage. So like, on month 360, when you're due to pay off your mortgage, there'll be $6,000 left on that mortgage, which hopefully by that time you can take care of. Or you obviously pay that $6,000 out when you sell the property. The next thing you can do is called a loan modification. It is what it sounds like. The lender will modify the loan. So they may extend the term of the loan. So you may have a 30-year mortgage. They can push it out to, I think, like 60 years at this point. I've seen one that was like 60 years. It was something wild, but the lender typically will push out the mortgage payment to maybe like 40 years or something like that. And what that does is, especially for like, let's say you're a month or year like 25 of the mortgage, pushing it out to a 48-year term obviously reduces your monthly payment. They may reduce the term as well. They may waive some of the interest due on the loan. But once again, you have to communicate with the lender to do that. So, and in all those scenarios, you still have to have a way to pay the mortgage. It's not like, hey, I lost my job, I can't afford to pay the mortgage anymore, I have no means of paying the mortgage. You're just kind of like jammed up in that situation. So in that scenario, what can you do? I mean, you can sell the property, right? So hopefully you built up some equity in the property by then, and just sell the property. Like, you don't want to go into foreclosure and then get your credit destroyed and not get any money from the equity you built up in the home over the last 5 years. So you can just sell the property, or another option is to potentially like rent the property out. Same thing, like if you're able to rent the property for more than the mortgage is, that's another good solution for you as well. Oh, and also, I mean, you just have the option just to refinance your mortgage payment as well. So let's say you did get a mortgage when rates were at like 7%, and like rates are down to like maybe like 4.5%, 5%. You can refinance your mortgage, and that will of course lower your principal and interest payment as well. So that's a solution that you can kind of proactively take, whether you can afford your mortgage or not. And lastly, I will put a description down below if you're kind of like in a bad predicament. There's the HUD counseling agency as well, which can help you with some potential solutions to your financial situation. But I go back to what I said in the beginning, like, what are you going to do if you can't pay your rent, right? I mean, you're going to just have to adjust your lifestyle to work things out, because I mean, I guess you can become a squatter, but I mean, if you can't afford your rent, you kind of get put out as well. But I mean, buying a home is the best way to kind of, for the most part, fix your mortgage payment. So I talked about a whole bunch of scenarios where your mortgage payment goes up, but your rent goes up as well, because your landlord is facing the same issues, except for they're facing the issues and they're looking to make a profit. So they're tacking some margin for their pledge, for their services, for their work on top of that number, for their effort, on top of that number as well. And so and also sometimes they just raise the mortgage payment like just because, right? They can just do that because they own the property. But yeah, don't be scared to buy a home because your mortgage payment goes up, your rent goes up. But as always, buy land, rumor has it, not making any more of it.